Hi there. Welcome to the Final Bar. My guest today is Craig Johnson, CMT, CFA from Piper Sandler in Minneapolis. Going to talk about the overall market environment, talking about stocks, also about interest rates. Today, we get some distribution on the S&P and across the equity landscape. All 11 S&P sectors finishing weaker, but the late cyclicals, the materials, energy sort of at the bottom of the list. So overall, is this further confirmation of resistance at S&P 3600? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets together through the charts, through the message that the charts can provide, focusing on investor psychology, on sentiment, on trend, on momentum, all those things that the charts can illuminate for us. Really distribution through the course of the day, a nice bounce sort of leading into the close, but overall the S&P finishing about 1% lower than it was yesterday. So, we've talked about for a while, we have this range from 3,200 to 3,600. We once again this week, especially on Monday, sort of gapped higher right above that 3,600 level. It seemed like some follow through through that resistance, but through then, from that moment, it's been more distribution than accumulation looking at the short-term read of the market. So we're going to try to pay attention to all the trends. And today in particular, we're going to focus on sentiment. Big change on the AAII survey on today's reading. I want to make sure that we update you on that. We have some wonderful guests coming through the Final Bar every week. And today I'm very excited to have Craig Johnson back on the show. Coming up on the 17th, on Tuesday of next week, we have Jesse Felder from the Felder Report. On Wednesday, Joe Duarte, StockCharts contributor. And then on Thursday, Mark Young from Wall Street Sentiment, which will be very interesting given what we've seen today on the sentiment read. Interested to hear Mark's take on that going into year end when he's here next Thursday. Also, as a reminder, we have the Money Show coming up, and I'll be speaking at the Money Show. I don't remember the exact date, but it's going to be next week. There's a whole Money Show virtual event, and I'll be giving a presentation on the bull market checklist and basically revisiting some of the mistakes that I find investors make when the market is at or near all-time highs. So go to moneyshow.com to check out the full schedule and to sign up there. Let's get to our market recap. As we think about the overall environment, we've talked about this range from 3,200 to 3,600. We revisited that pretty often. And, I think what we've seen in the short term is certainly the market coming off that 3,600 level. And the question, the open question is there enough buying power to propel the S&P above previous resistance and really push us to the next level? And I think the biggest question is what is or what could be the leadership that would be able to elevate that? And there have been times like, in the last day or two where it felt like technology reemerging as the FANG trade reemerges and pushes the S&P to new highs. But other times it's sort of the financials, materials, energy, industrials gapping higher. And today, like today, it's telling you basically nothing's going to lead. We're all sort of rolling over. What's interesting is the S&P down 1%. We continue to see mid caps and small caps a little weaker. With the small cap index, the S&P 600 closing down about 2%. The Nasdaq 100, the best of the bunch, down just over 0.5%. And the VIX a little higher, back above 25 today. Bond markets were closed yesterday for Veterans Day, but the bond prices back to the upside today and yields down a little bit to around 88 basis points on the 10-year. On the commodity side, you have gold and leading the way higher, really, with the GLD up 0.6%. Silver essentially flat. Oil down a pretty good clip, and energy the weakest of the 11 S&P sectors. Let's look at a chart of the S&P here as we update it for the close. So, again, this range that we've been talking about is sort of this blue support area around 3,200 to 3,250, excuse me. That was the high from June, the lows from July, the low in September, and again, the low in October. So, fairly comfortable with the fact that if we would get broad distribution, I think that's a really key line in the sand. As long as we remain above 3,200, overall, the structural positive trend is certainly in place. And as we've seen in the last couple months, we can shop around a range for quite a while. The question though has been when we've tried to regain that resistance, we've approached that 3,600 level. Are we able to propel beyond that? And from the moment we've traded above it, we closed back below it on Monday. That was the gap higher on the the election confirmation, or confirmation is a loose term at this moment, but the the prospect that that Biden had won. But the Pfizer news as well coming over the weekend, and so or into Monday morning, and so closed back at the lows of the day on Monday, and since then it's continued to sort of chop around, and today's certainly the lowest close of the three. So this resistance from early September certainly appearing to hold. I'm calling it a range based on the October high, so giving it sort of that 3,550 to 3,600 range, which is the green shaded area here. So at this point, my base case is we remain range bound until proven otherwise, and I see plenty of signals suggesting short-term pullbacks from the elevated levels we've been at. Just like if we would get to 3,200, I think you'll see plenty of signals that stocks are potentially could bounce up from pullback levels. What's interesting to me though is you think of the symmetry of the market. You look at the February market high, and you look at where we're at, we're sort of at the midpoint, that 3,400 level, sort of the midpoint of this range that we've been in. So, if you summarize all of this as sort of a rotation around that 3,400 level, it lines up actually pretty well with the February high. And we have been propelled to that level and now are sort of stabilizing around that same equilibrium point. The 200-day, the 50-day moving average notably is almost dead flat right at that midpoint at 3,400. So, a breakout remains to be seen. We have not gotten that, and certainly through today's close, we didn't as well. Let's look through some other charts and see what sort of themes we can tease out. As we look at the industries, is a bit of a bounce going into the close. I was actually looking at this group for just a few moments ago. There's only one of the 100 plus Dow industry groups that we track during the day. Only one of them within consumer staples, which is food retailers and wholesalers. It's things like Cisco, not the CSCO Cisco, but the SYY Cisco, the food distributor that was in there. So that it's a pretty specific group within consumer staples. But by the close, you can see that a number of groups actually finished in the positive. It's always interesting on a big down day. And again, this is not a huge down day, but on a day when most things close down, what was actually able to hold up a little bit? You see a number of consumer staples in here: non-durable household products, personal products. These all finished in the positive. Mobile telecom, which is in communication services, finished in the positive. It's actually continuing a nice run off of the previous swing lows. And biotechs, which finished sort of flat down a little bit, but overall holding up pretty well. So as the S&P's coming off a bit, you have some of these groups that are actually holding up. What actually drove us further down? A lot of energy in here. You have pipelines, you have E&P stocks, airlines coming off as well. And I think we talked a little bit about the charts of airlines. I just want to hit on Delta very quickly. I think the market has a memory, and I think there's a reason. I always mention when you see the price move, especially on a gap, look to the left, sort of drag your eyes directly back to the left and see where we've been before. And I think if you did that on the chart of DAL, you see the resistance from June. I don't think it's a coincidence that we gapped right up to that same level and now have sort of pulled back from there. So, a gap is in some ways unpredictable, but what happens afterwards, right? How investors treat the price after that sort of gap and how we react further from those key levels can be pretty important. I think it's interesting to know that airlines essentially have pulled back after that gap up on Monday. Continuing on, let's go through some of the other asset classes very quickly. We talked about gold, and so I just wanted to hit on the chart of the GLD, which is here. Nope, here we go. Sorry, I'm all over the place with these charts. Chart of the GLD, here we go, intermarket analysis, and gold, here we go. So when you talk about the GLD, it's essentially been weaker rather than stronger. You're seeing continued patterns of distribution, but what's interesting on a chart of the GLD is we're entering, in some ways a confluence of support. This is a 38.2% pullback level. If you look at the March low to where we were at in August, we've sort of pulled back just above that. We're sort of a rounding error away from that 38.2% retracement. This also lines really well with a 61.8% retracement of the June to August peak. Fibonacci levels for me are of interest. What's even more interest is looking at the trend and seeing the movement in some of these charts. So as long as that holds, that sort of 171 to 172.50 level, we'll call that, which sort of this range right here, this purple shaded range. There's a number of Fibonacci levels, but it's also where we bottomed out before. So as long as we hold this sort of range, overall, it's essentially a pullback and then a resumption of the uptrend. But the last attempt gold had, which was at the beginning of November, sort of fizzled, and now we've pulled back down to these levels. I think a breakdown below that sort of 171, we'll call it, which is the 61.8% retracement. We break below that, I think you have to start thinking a little further down, maybe looking back at some of these previous lows back from May and June, which is interesting for sort of the risk-off trade, something like gold, where a lot of people would consider it a safe haven. Interesting to see it actually continuing to roll over as the S&P continued to test the previous highs. We're going to take a quick commercial break. That's our market recap for today. We're going to be back with my guest, Craig Johnson from Piper Sandler. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday for our show as we debrief on the charts of the day, key breakouts, breakdowns, patterns, and how they're evolving. As a reminder, we love to hear from you. We're going to do another mailbag segment in Friday's show, and we'd love to answer one of your questions on the air. You can get your questions to us a couple different ways. The one is by email, thefinalbar@StockCharts.com. is the way to get it to us. Number two, on Twitter, just tag us in a comment at FinalBarSCTV. Number three, put a comment below any YouTube video you're watching on our channel, and we'll make sure we capture all those. Again, we'll do another mailbag segment on Friday's show, and we'd love to answer one of your questions on the air. I want to welcome on my guest to the show, Craig Johnson from Piper Sandler in Minneapolis. Craig's been on the show a couple times. We interviewed him for Behind the Charts. It was one of our first interviews, Craig, at the end of last year. And I appreciate you not dwelling too much on a friendly wager we made months ago when you insisted the S&P would reach 3,600. I insisted it would not. And I have to admit that was a correct call. You won that one. And I eagerly await our next friendly wager, but welcome to the show.
Dave, thanks for having me back on. You know, the thing is, I'm getting older, so I remember the wager, but I don't remember what the bet was. So
in that case, it never happened. All right, there was no wager. Then that's fair. Good. We're getting to the market. Obviously, you know, the S&P approaching 3,600 really has been trading around it, and the open question: where are we at right now, and what does this mean for between now and year end and beyond? We're starting with a pretty long-term view, the weekly chart of the S&P. Yep. Talk us through your take here.
Yeah, so let me walk everybody through this. So I like to start with a long-term picture and then sort of narrow it down as we kind of try to make our trading decisions about this. But the first thing that strikes me about this pattern that I'm seeing here is a series of higher highs and a series of lower lows, you know, and it's kind of a broadening pattern. These are patterns that I've seen happening back in the 1960s through the 1970s before you finally broke out to a new secular bull market. We also saw this sort of happening when you thought about 2000 to 2013 period of time too. But at this point in time, Dave, I look at this and I look at the price action this week with that final bar that we have up there, and that almost looks like a little bit of a blow-off type move. It was very interesting is that there's something I hadn't seen in quite some time. First and foremost, what I was seeing is a 2% gap up on Monday, and then we closed below where we sort of gapped up from. I look back over 25 years of data, Dave, and I never saw anything like that happen in the past. So that leads me to be a little bit more speculative in terms of this is perhaps a blow-off-ish type move. So I'm watching that very carefully. So the second thing I've been watching is in our internals, Dave, is that I've been watching the fact that 92% of all the industry groups, and you did a great recap of all the industry groups here earlier on the show, but 92% of our groups are above a 40-week moving average. I rarely see that happen. In fact, it hasn't happened since 2014 that we've had more than 90% participation of all of our industry groups above their 40-week moving average. Dave, the other thing I've also seen is the S&P 500 and the NASDAQ ratio had broadened out to a degree that we haven't seen since 2008. So there's some clear warning signs out here. But if you zoom into the next chart for the S&P 500 on a shorter term basis, again, I come back and I look at the setup in here, and I'm not sure if this is a double top potentially in the making or potentially a triple top, just a little lower there in the middle. But when I think about the closing prices, I think this is price action that ultimately has to consolidate. And Dave, I would agree with you that we probably need to come back down to, retest at minimum your 50-day moving average in here at 3402, or perhaps come all the way down to 3200 again, which is a really key support level, and retest that. I've thought for a while that there's a lot of good news that's been sort of baked into this market. Now we've got the Pfizer drug that has been announced. We got very high participation in terms of our group work. And the other thing that I'm watching carefully is we're not getting a lot of participation from the FANG stocks at this point in time. Looking at charts like Apple and Amazon and those names, they're not making higher highs anymore. And again, that has been the leadership of the market. And I think the last time we were on the show, we were talking about the concentration of this market too, Dave, where we got the 5 largest stocks representing about 20-25% of the entire market capitalization of the S&P 500 and about 45% of the NASDAQ 100. So if the NASDAQ 100 starts underperforming the S&P, that to me is a concerning sign. And we all know from looking back at history that when the generals get out on the field and they get shot, it's very difficult for some of the popular averages to keep going. Now, that all being said, Dave, I think the longer-term secular bull market is intact. I just think we're going to have to see some further backing and filling as we start to watch interest rates start to change. And that would be the final chart that I'd ask you to bring up. Because the number one question I'm hearing from customers and clients universally at this point in time is, what does it mean that rates are trying to move above 90, 95 basis points on the 10-year bond yield? We still got a long way to go before we reverse the downtrend off those highs in 2018, but clearly something is changing, okay? We know that the Fed is going to keep rates anchored at the very, very low end or the very short end of the curve, but we're also seeing new stimulus packages and certainly a potential change in Washington in terms of the administration and perhaps more stimulus coming into play. And if we're going to get a lot more stimulus coming into this market, I would expect a little bit dollar weakness, and I'd also expect interest rates to start to move up. So if that's the case, the number one thing that people are looking for is the script going to get flipped in terms of buying growth stocks versus value stocks? And I think as interest rates go up, the narrative that we've been hearing for years now, which is when you're working with a dividend discount model and your risk-free rate, which is your 10-year bond yield, is going down, you're going to keep assigning a higher multiple to stocks and specifically to growth stocks. And that's exactly what's been happening. But as rates have started to move up, we've been seeing some compression happening with the multiples for those stocks. And so I think rates moving up, it's going to be very difficult for those growth stocks to continue to outperform. And again, as I just said, they're a huge part of the overall weight of the market. So we need to watch this particular script getting flipped very, very carefully going forward from here. Dave, the consensus is that rates can't go up and won't go up for any meaningful period of time. And when the consensus is leaning all one way, I tend to like to lean the other way, just to be a little bit different, I guess. But the consensus usually is not correct, and nobody thinks the rates can go up right now. And I think the Fed has kind of told us that they're going to let inflation run hot. I think that means the long end ultimately has to go up, and we are going to see weakness in tech and probably further strength in the financial sector.
That's such a great take, Craig, and I appreciate that illustration of how the yield curve and really the shape of the yield curve adjusting, how that what that might mean for the growth versus value trade. Despite the fact that you brought up the dividend discount model on my show, I appreciate you coming on, Craig. Good to have you back. Hope you and everyone around you stay safe, and we'll talk to you again soon. All right.
Thank you, Dave. Appreciate it.
That's Craig Johnson, CFA CMT, Chief Technical Strategist at Piper Sandler in Minneapolis. I've followed Craig's work and have known him for a number of years, and certainly miss getting his big book called The Informed Investor. It's a monthly publication that he sends out to institutions. And he mentioned his industry group. It's some of the best work I've seen, looking at, really breaking up the market into what they call micro groups, little individual narrow industry groups, and the breadth that you were able to do from looking at that slice of the different groups was really, really valuable. Great to get his take on there. Let's continue on to our next segment called Getting Sentimental. So every Thursday, you tend to have between Wednesday and Thursday, you have a lot of sentiment data that starts to come out. And I wanted to just highlight some of the things that we're seeing. We're going to start with just the VIX. We're going to use the sentiment indicator chart list that I use pretty regularly on the show. If you don't have this, or if you want to get some of these charts, the easiest way is actually on the member dashboard on StockCharts. So if you go to your member dashboard, you click on chart lists on the right. I have way too many of these, but that's what happens when you like looking at charts and you like putting them in different lists. But if you get to the bottom, you'll see this thing that says Manage Chart Lists, and you'll see David Keller's morning coffee routine chart pack. Just install that, and it'll have all the charts we're going to talk about here in a chart list called Sentiment Indicators. Let's start with the VIX. We think about volatility. Overall, when I talk about an increased volatility overall in the markets, and I've gotten some pushback saying, well, hold on, isn't the VIX way down from where it's been? And you're right. I mean, going into the March low, the VIX spiked from 12 on average, 10 to 12, going up to the low 80s, which was an extreme high reading by any historical perspective. Since then, came back down below 40. We've sort of tested that on the last couple of pullbacks, and right now we're right around 25. But if you look over the deep history, I would still consider 25 a rather high level for the VIX, and so that's why I keep talking about elevated volatility. It's less that right now we're high relative to where we've been for the last 6 months, but it's telling you right now we're high relative to where we were for most of 2009 to into the February peak. So overall, volatility has been increased, and I just think the nature of what we've seen in the last 6 months certainly speaks to the extreme movement that we're having in stock. So if you look just at this most recent data, if you look at the last 6 months, the VIX being below 25 is sort of where it's been when we lead up to some of these market peaks. So in June, you had a VIX bottom out around 25. Here in July to August, a little different because it went below 25, remained below there for quite a while, and then sort of came off and increased going into the September peak. Right now, we're back below 25, sort of similar position to where we were in June. For me, the VIX, to be honest with you, is less predictive and it's more descriptive of the conditions of the market. And for me, it speaks to the elevated volatility I think that we're all experiencing. This next chart is an interesting one. This is the AAII survey, and I actually did a double check on the data when I saw the spike in it, because it's a huge move from where it was last week. One of the main stories we've been talking about in terms of sentiment is the fact that the AAII, American Association of Individual Investors, we're asked individual investors, are you bullish, bearish, or neutral on stocks for the next 6 months? And overall, the ratio has been favoring the bears over the bulls, meaning there have been more bearish respondents than bullish respondents really since the February market peak. That was the last time you had a net bullish reading on them. Since then, it's essentially been negative. And that's the panel you see at the bottom here. The green bars above there represent bullish respondents. The red bars are bearish, and then the red in the very bottom shows you, the difference between the two. That changed about a month ago when you finally had a net positive reading for the first time in a while. And I asked Mark Young from Wall Street Sentiment last time he was on the show, what does that mean? And his answer was that's less informative of the fact that the bullish reading is not anywhere near bullish extremes. It was still below 40%. He was like, until you start getting, more 40, 45%, that's what market tops are more made of. So interesting to see today, you now have the biggest spread to bulls to bears that you've had since 2017 to early 2018. You have more bullish respondents at 55% since you've had in 2018. So we're all of a sudden at extreme high levels of bullishness. The spread between the two is extremely high. And the level of bears, I don't have the line quite in the right place. It's a little bit lower here, around 25% bearish. But this is one of the lowest readings that we've had in bearishness in quite a while. So all of a sudden, very quickly in 1 week, this has gone from not quite indicating bullish euphoria to all of a sudden being at extreme high levels of euphoric levels. And I think related to what Craig was talking about in terms of the broadening top pattern in terms of where we're at the upper end of that, I think there's a lot to be said for an extreme in sentiment that tends to line up with that as well. I want to look at the name exposure index. I've not looked at that yet this week, and I just wanted to touch on it very quickly. So it's interesting, in the last 4 weeks, up until this week's reading, you had a steady decline of bullish positioning. This is from Active Investment Managers, the name exposure index. So it's basically how exposed are you to equities, and it can go above 100%. Obviously, with leverage, you can find different ways of getting there, but it gone steadily lower and lower over the last 4 weeks. A spike higher this week with almost 100% bullish positioning in equities, just under that 96%. Also, the RIDEX flows, which looks at positioning in bullish funds versus bearish funds, essentially at an extreme high positioning as well. So the sentiment reads from what I'm looking at have certainly changed very quickly from where they were. And just the last week was an incredibly meaningful week in terms of that rotation. The last thing I'll leave you with is, and I feel like I'm making a pretty bearish argument altogether, and again, it's just looking at the data here. The other thing we'll point out here is the put-call ratio. This is the equity put-call ratio. A lot of times there's a total put-call ratio, which includes equity and other assets. This is just looking at the equity side of things and looking at puts versus calls and how investors are positioned. This is in pink, the 5-day moving average, just because the put call ratio itself, the raw data, is kind of noisy, and you can see it's chopped around a little bit. I would note that we spiked down to the lowest level in that put call ratio that we've seen in years, and overall the 5-day moving average of that is certainly back at the levels at which we've seen previous market tops. We're back in that range where we saw in the October peak and the September peak, also the June peak as well. So overall, from a sentiment read, very quickly we went from we're not overheated yet to, I would argue most of these are overheated or very close to that, which certainly speaks to, I think, again, sort of further validating S&P 3600 as a pretty key line in the sand that I don't see us going meaningfully higher from. That is our segment, Getting Sentimental, trying to focus on some of the key sentiment reads. And again, excited to have Mark Young on the show next week. We'll ask him some of these follow-up questions as well. We need to wrap this show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the Value Line Arithmetic Index. This doesn't update until the next morning for us. So this is up through yesterday's close. But a hat tip to my friend Ryan Dietrich from LPL Financial. He tweeted this out yesterday, the day before. I want to say, just pointing out how this had actually broken to new all-time highs. So while the S&P sort of floundering, while small caps and others unable to push through to S&P 3600, go to new swing highs. Value Line Arithmetic actually already has. The way to think about this is it's essentially the average stock is how you would think about that. So again, one data point certainly suggesting we're at all-time highs. Worth noting, it's overbought for the first time since back here in August, where it sort of stalled out for a little bit. But that's certainly one thing to watch to see if that's able to hold its breakout level from its peak earlier in January. Chart number 2 is the breadth by cap tiers. Again, this isn't quite updated for today's close, but through yesterday's close, you can see that the S&P advanced decline line and the mid-cap cumulative advanced decline line both had already broken to new swing highs. What's happened in the last couple of days is you've seen the small cap breadth line actually break to new highs for the last 6 months. It's actually breaking above back to the level that it was back there in February. One of the key points to my lack of confirmation thesis with the fact that you didn't have a breakout in the cumulative advanced decline lines for small caps and for the New York Stock Exchange. What's interesting to see is now all 4 of these above their highs from August. So while sentiment has reached extremes, and when you're looking at some of these breadth measures like the Value Line Arithmetic Index, looking at the cumulative advanced decline line, it's actually starting to finally break out here. So it's an interesting sort of role reversal where you've seen sentiment extremes and breadth, I think, starting to almost be a little bit supportive. To finish our 3 and 3, though, I'll leave you with the chart of the AAII survey. Again, this is a pretty severe change in the reading from what we've seen historically. And I think looking back at some of these historical peaks, thinking about where we're at relative to that range and seeing sentiment get this overheated as we're testing resistance doesn't make me feel great about the appetite for investors to put the market to extreme highs, materially higher from where we're at. So I think at this point, I'm seeing limited upside in stocks, although I still would say, I would argue, as we have been for a while, just because the overall S&P could hit resistance at 3,600 does not mean that there aren't individual stocks and groups that are able to break out, just like as there are ones breaking down. So I think from a stock picking perspective, that's where you want to focus. Folks, that's our show for today. A special thank you to Craig Johnson from Piper Sandler joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.